Investors all over the world wonder what is the best and simplest way to invest their money, whether it's for a retirement account, a taxable account, or even just for general investing to get the most out of their money. Now, the solution to this problem is called the three-fund portfolio, which is a very popular investment strategy comprised of three different asset classes involving buying index funds. Now, if you're wondering, well, Marcos, what is an index fund? Well, an index fund is a basket of stocks that tracks or mimics a specific index. For example, the S&P 500 tracks or mimics the largest 500 US companies by market capitalization. Now, in a three-fund portfolio, the three different asset classes are US stocks, international stocks, and bonds. So you typically have one portion of your portfolio into US stocks, another portion into international stocks or the emerging markets, and then your last portion allocated to the bond market. And for a long time, that was the general way to invest in a three-fund portfolio. It was what everyone was talking about to allow a simple portfolio to build long-term wealth and have a balanced investing approach. But in this video, I'm going to show you guys exactly how to build a traditional three-fund portfolio, and then I'm going to show you guys my new and improved three-fund portfolio, which will hopefully yield a higher return and allow you guys to make more money in the long run, because who doesn't love a good challenge, right? This is going to be a fun one. If you haven't subscribed already, please subscribe because it helps the channel a lot, and let's get started. So to build a traditional three-fund portfolio, you want to have your first portion allocated to US stocks, specifically the total stock market. Now, the best ETF that tracks this index is going to be VTI by Vanguard. Now, there's other mutual funds by Fidelity, by Vanguard, and Charles Schwab that mimic all the stocks I'm going to be talking about. So I'm going to be listing them on your screen as alternatives. Now, another fund that is similar to VTI is going to be VOO, which is the total S&P 500 market. Now, you can invest in VOO or VTI, but for this example, we're going to be using VTI as a traditional method. Now, the second portion of your three-fund portfolio is going to be allocated to the international stock market. Now, the best way to invest in international stocks is going to be VXUS by Vanguard. And then the third portion of your three-fund portfolio traditionally is going to be bonds or the total bond market, which is going to be called BND. And that's going to be the ETF that tracks this whole index. Now we're going to look at the historical performance of these funds and how much money they've returned to investors in the past year and in the past 5 years. On your screen, we're going to be taking a look at Vanguard's total stock market ETF, VTI, and in the past year they're down 7.54%, and that's just due to the high inflationary, high interest rate environment that we're going to be in, that we're currently in. And in the past 5 years, we scope out, they're actually up over 45.62%, which is very strong returns because the stock market has been rocketing in the past 5 years. If you invest in the stock market, you would have made a ton of money just in these high bull runs that we've been having. So if you invested, $10,000 in the stock market 5 years ago, you would have made almost $5,000. So VTI is a great stock to have in your core of your portfolio and even in a three-fund portfolio for the first portion. Now, if we take a look at VXUS, which is our total international stock market ETF, it's actually down 5.85% in the past year, which is down a little bit less than VTI. But if we scope out and see the past 5-year performance, they're actually down 2.72%, which is very bad considering that the US stock market has been up over 45% given all the highs and lows that the stock market has been having. So if we invested $10,000 5 years ago, we would have lost some money even in the past year as well. And international stocks are traditionally more risky, so seeing these returns is something I don't like to see, as this is the traditional way to invest in a three-fund portfolio. Now we're going to be taking a look at our last portion, which is going to be to bonds, more specifically BND by Vanguard, which is the total bond market ETF. Now in the past year, this ETF is actually down 11.88%, which is actually more than international stocks and more than US stocks. And this is not what I want to see, because let's just say the stock market is down 10%. I want to see bonds down less than 10%, traditionally, 3 to 5, maybe even 0, just because, the purpose of bonds is to preserve our capital and to have something that's more safe, less risky, and have less volatility. Now, as you see on our screen, we see a lot of volatility in bond market prices. And in the past 5 years, it's actually down 9.38%. So if we invested $10,000 5 years ago, we would have lost almost $1,000 by investing in this bond market ETF. Now, past performance isn't an indicator of future results. The reason why bonds are kind of falling just because of the macroeconomic environment that we're going to be in and that we're in currently. In the future, I think bond prices might increase, but this is just the environment that we're in now, so don't take this for too much consideration. We have a source by clevergirlfinance.com on how to allocate a 3-fund portfolio. So if you're, want to be more aggressive in your, into your early investing journey earlier in life, you want to have an 80-20 split of your portfolio, 80% to stocks, 20% to bonds. Now, traditionally, they say 64% US stocks, 16% international stocks, and 20% bonds. Now, if you want a more moderate approach to this 3-fund portfolio, and you're, in your midlife, you're not, really young, but you're not really old into your retirement, you could use this equal portfolio, which is going to be 33.3% to US stocks, same thing for international stocks, and the same allocation to bonds. Want to be more conservative, and you're, into your later years of your investing journey, later in your life into retirement, you can use a 20-80 split, which is going to be 20% stocks and 80% bonds, and they say 14% US stocks, 6% international stocks, and 80% into bonds. Now, the great thing about M1 Finance is that we can have our own custom pies, which can see the performance of these pies in the past year, in the past 5 years. So if you guys want to, customize your own portfolios, you can use M1 Finance to do that. So on your screen, we're going to use M1 Finance to track our 3-fund portfolio. For this example, we're using the aggressive setting. Our targets, we have that 64% to VTI, 20% to BND, and 16% to VXUS for our aggressive portfolio. And if we can see our performance in the past 5 years, it's up 29.28%, which is great to see higher returns. And this does not, keep up with the stock market though, which is why I don't like the traditional way of, the investing strategy of a 3-fund portfolio. Because as we saw, the total stock market was up, if you just had that only allocated, 45%, and I believe VOO was on track with that or even a little bit higher. So this is what the performance of an aggressive level 3-fund portfolio looks like the traditional way. On the moderate level, so we have 3 holdings, our expense ratio is 0.04%, and our dividend yield is a lot higher than the aggressive portfolio at 2.35%. And the reason why is because if we have an equal weighting to international stocks and bonds, international stocks typically pay a higher dividend yield than US stocks, and bond yields obviously pay a higher interest rate for people to invest their capital into bonds. For our targets, they're all equally weighted, except for VTI. It has a 34% allocation because M1 Finance doesn't allow you to have the exact decimal points of 33.3%. So we just allocated that last percent to the core of the portfolio, which is VTI. And if we look at the performance of it, it's up 13.29%, which is not on track of a traditional, S&P 500 index fund or a total stock market index fund. So this is kind of why, like I said, I don't really like the traditional way of the 3-fund portfolio. At the performance of a conservative level approach to our 3-fund portfolio in the traditional way, as you can see, the targets, 80% bonds, 14% VTI, and 6% to international stocks of VXUS. If we look at the performance of it, it is kind of exactly what I expected of a traditional 3-fund portfolio, as it's down 0.65%. However, you're actually up because you're collecting that yearly dividend of over 2.4%, I believe. This is actually really good when you're in your retirement and you don't want to have too much capital loss. Now for the meat of the video on the new and improved 3-fund portfolio to outperform the traditional one to hopefully yield a higher return. Now, how I would approach this new 3-fund portfolio is to take out international stocks and replace it with a growth fund, which is going to be a schg, which is Charles Schwab's growth ETF. And there's many alternatives to Charles Schwab's schg, such as VUG, which is Vanguard's growth fund, and maybe even QQQ or QQQM by Invesco. The reason why I'm going to be using a growth fund is because if we're already going to be investing in high risk assets, which is going to be international stocks, you might as well replace it with a growth ETF. Like I said, past performance is not an indicator of future returns. So for all we know, maybe in the next 5 years, international stocks do well, but you never know, growth stocks can outperform that. In the past 1 year, the schg ETF is down 12.22%, which is actually more than S&P 500 and even our VTI total stock market ETF, because like I said, growth funds are more risky, and when the stock market goes down, this will actually go down more than the current market. And in the past 5 years, when we scope out, it's actually up 67.47%, which is great returns that are actually almost 20% more than the total stock market and even, the S&P 500. The reason why is because when you're investing in a growth fund, you could have higher highs than the current stock market, and you're going to be compensated for more returns due to investing in these risky assets. Now, the second way that I've actually improved the traditional 3-fund portfolio is to actually cut out bonds entirely and to replace it with a more value dividend investing approach, which is going to be schd by Charles Schwab, which is a dividend ETF. Other alternatives to schd, such as VYM, DGRO, etc. Now, if we look at the performance of schd, we could see that in the past year, it's down 2.85%, which is great because dividend stocks, like I said, are less volatile and they're going to be more predictable in terms of the income they receive, and it's going to be preserving your capital. And in the past 5 years, it's actually up almost 50%, more specifically 49.53%, which is actually outperforming VTI and even the S&P 500. Charles Schwab's dividend equity ETF is such a great ETF, even standing alone and even in a 3-fund portfolio. I've inputted into M1 Finance our new 3-fund portfolio in the aggressive manner. Targets are as shown. If you see our performance over the past 5 years, we're actually up 52.96%, which is over double the way the traditional aggressive approach in the 3-fund portfolio is. So in the title, you're going to see 2x returns, and no, that was not clickbait. Let's see the moderate level approach in our new and improved 3-fund portfolio. Targets are as shown. You see the performance, we're actually up 57%, which is up even more than the aggressive level approach. And the reason why is because we have a higher allocation to schg and schd. And like I said, schd outperformed the total stock market and even the S&P 500 in the past 5 years. In schg, we have a higher allocation to growth funds. They're going to do well in the bull run, which is what the general stock market has been doing the past 5 years. Now let's see our performance for our conservative level approach into our new and improved 3-fund portfolio. For our targets, you're kind of wondering why schd isn't 80%. As I said, that would replace our bonds, and schg isn't included. And the reason why is because I don't believe you should have all stocks into your conservative level approach into your retirement. That's just not smart, because when stocks would go down, even if stocks were to crash, your whole fund would go down essentially. Versus if you had bonds in, you would be a lot more stable than if you didn't have them in your portfolio. If you see our performance, it's exactly what I expected of 2.57%, which is over double than what the traditional 3-fund portfolio does to preserve your income and have capital appreciation. So that's great to see, and that's just my new and improved way of approaching 3-fund portfolios. Now, as a disclaimer, I am not a financial advisor, and you should always do your own research before you buy anything stock related or even just in general. Because at the end of the day, I'm just some guy on the internet who loves investing, and this is more of an entertainment purpose video. So if you enjoyed this video, please leave a like because this cute puppy did, and comment down below maybe a stock that you're investing in to buy and hold forever. I love you guys so much. Please have an amazing day and continue to crush in the stock market and out there in the real world. See you guys in the next one.